Hello, and welcome to another edition of Selling Life and Annuities. I'm Tim Booby. I'm the National Sales Director of Annuities at Gordon Marketing, and with me today is Paul Bechtold, our Regional Vice President and the manager of our debt programs here at Gordon Marketing. And today's topic is credit card debt hits $1 trillion. Okay, so Paul, $1 trillion in debt. That's a huge number. Can we talk a little bit about the significance of that?
Just put it in perspective, my high school history teacher told me this is back when our national debt was $1 trillion. He said, $1 trillion is a stack of $100 bills 1 mile high, okay? And what's significant about that is, although that's a lot of money, there's other forms of debt. There's auto loans, there's mortgages, there's student loans. Student loans are getting ready to kick in here soon. But it's kind of a bellwether of the economy, of the status of our economic condition in this country and people's abuse of maybe credit, and that people are getting themselves in deeper and deeper trouble with debt.
That's interesting. So they're getting in trouble, but somebody's making money on this, right? So who is making the money, the profit from these credit cards and the credit card debt in America?
Well, that's a great question, Tim, because I think people kind of have in their mind that when they hear MasterCard or Visa or something, they think there's this company, and it's really just a bank. All debt ends up going in the pockets of the bank. It all goes to the central bank, okay? So what we teach people is that money either is in your field of wealth working for you, or it ultimately ends up in the bank's field of wealth for them to make money off of your money. And if you don't understand how interest works, how interest is calculated, et cetera, you're always feeding the banking cartel and making them profitable.
So you raise a question, to a degree. So, how is the interest calculated?
That's a great question too. Okay. And depending on the kind of debt you have, for example, a mortgage, a traditional, 30-year mortgage, 15-year mortgage is an amortized interest loan. Interest is credited out and it's front loaded to the front end of the loan. Now, a credit card is actually calculated on what's called average daily balance, okay? So the first problem most people get into with their debt is they pay attention to what's called the APR, the annual percentage rate, right? And that is not the true indicator of what the interest is. Depending on how the interest is calculated, the effective interest rate could be much, much higher than that. In the case of a credit card, it's calculated on an average daily balance. They take into account over a month's time what comes in, what goes out, what you charge and all that, and they average all that out, and you're charged interest on that average balance over the month.
Now, that's interesting. Now, you're talking about but different people get different rates and different terms, right?
Correct.
So how does that factor in? How do they determine what rates and deal, people get?
Well, a lot of that is credit driven. A lot of that is measured on your debt to income ratio. Another factor that affects that, Tim, would be the economic environment that we're in at a given time. 2008, 2009, for example, when credit really tightened up, rates tend to go higher, right? The other thing people need to pay attention to is, do you have a fixed rate or is it variable, right? As you charge more and more and your debt to income ratio goes up and your credit gets worse, they can charge you more interest as well.
Right. Okay, good. So Paul, you manage our debt reduction programs. And I think your new program is EquityXL.
Correct.
Right. So how does EquityXL, I believe, is what we're talking about here. How does EquityXL fit into this dilemma, this significant debt?
Okay. Well, in particular with credit card debts, that's a very good fix for EquityXL. Okay. Most people that have credit cards have several of them. Okay. Most people are paying more than just the minimum amount on their credit card. And what we do is we analyze somebody's finances. We ask them to share some financial information, look at their economy. What we do is redirect their money in a much more efficient manner where it is going to be working for them via a dividend paying whole life insurance contract so that we can get their money earning interest for them. And then we build the cash value up and sequentially pay off their debts one at a time, usually from the smallest down to the biggest one. And we recoup a lot of that interest that they would be paying to the bank and pay it back to themselves instead.
So you're helping them reduce the debt. Now, how do you know when that's necessary? Like what's too much debt for an individual?
Actually, what's funny about that is when somebody has a lot of credit cards, the more layers of debt they have, the more credit cards they have, the better it will actually make the report look, because we can implement a snowballing strategy and roll those payments down and accelerate them to get rid of the debt faster and faster and faster.
Interesting. So can clients get completely away from credit card debt?
Absolutely. They want to. We teach a concept called becoming your own banker. So the first part of that is if they have debt, using the infinite banking concept to eliminate that debt, and then ultimately building that cash value up for future needs. Most people are going to buy another car in the future. They're going to make another significant consumer purchase, maybe go on vacation. You can pay your taxes with this. You can do any number of things with this. Instead of borrowing somebody else's money, you leverage your own instead.
Right. Interesting. So for the benefit of those watching our video today, Paul, if they're interested in learning more about how your programs can help with this situation in America, how do they engage?
Well, paul@gordonmarketing.com. My cell phone is 317-626-3054. Reach out to me. We have got this streamlined and simplified to the level of find a client, get a one-page financial fact finder completed, bring it to us, and we can show you and quantify for you exactly when that client will be debt-free. You don't have to do all the heavy lifting. You don't have to know how it works. We will teach you along the way. And it can be as much or as little as you want to mess with, okay? If you want to learn how to do this, we'll be glad to teach you. We do extensive training on this, but if all you want to do is find the client and bring the case to us, much like you do, Tim, we can make it very turnkey for them and be solution focused.
Great. Good. So we're kind of winding down on time here a little bit. So before we leave, though, if you would do us a favor and please subscribe to the Selling Life and Annuity videos today. And if you would hit the notification bell so that you'll be made aware every time we come out with a new SLA video, that'd be great. And of course, if you'll like, comment, and share on the content we provide, that'd be terrific. So with that, thank you very much for your time and attention, and happy selling.